How a routine decision altered market psychology. It began as an administrative choice, made without urgency and without debate. A routine decision, approved in minutes, recorded in a system log no one would revisit. At the time, it looked meaningless. But that single change quietly reshaped how the market behaved long before anyone realized why. To understand why this mattered, we need to return to a moment when confidence depended on predictability. Markets moved within familiar ranges. Participants trusted established reactions. When conditions shifted, behavior followed a script refined over years. Psychology felt stable because expectations felt shared. This story matters now because markets aren't driven by information alone. They're driven by belief about how others will react. When those beliefs change, even slightly, the entire system responds. And sometimes that shift begins with decisions so routine it barely registers. The first reveal begins with a regulatory operations team updating a long-standing procedure. The change wasn't strategic. It wasn't about control or intervention. It was about efficiency. A minor adjustment of timing, when certain actions could be taken and when they would be delayed. On paper, it reduced friction. In practice, it altered incentives. The second reveal came when market participants adapted almost immediately. Not consciously, behavior shifted automatically. Traders delayed decisions they once made instantly. Liquidity providers widened terms slightly, sensing more uncertainty around response timing. No rule had changed materially, but expectations had. The third reveal emerged in behavior during minor stress. Small disturbances lingered longer. Price discovery slowed. Participants waited instead of acting, unsure how others would respond under the new timing structure. The decision hadn't restricted action. It had introduced doubt. And doubt, once injected into a system built on anticipation, spreads faster than any policy ever could. What followed wasn't a crash or a crisis. It was a slow rewrite of market psychology, one quiet decision at a time. At first, the change looked harmless. Volume stayed healthy. Prices moved within expected ranges. Volatility remained contained. To anyone watching from a distance, the market appeared unchanged. But psychology doesn't shift in charts. It shifts in hesitation. The conflict emerged in how participants interpreted the new timing. The decision created a subtle gap between action and response. Traders no longer knew exactly when reactions would occur. Liquidity providers questioned whether support would arrive immediately or later. That uncertainty didn't stop activity, but it slowed commitment. Market makers adjusted first. They didn't pull back entirely. They added caution. Quotes widened slightly. Size thinned at key levels. Not enough to alarm anyone, but enough to change how quickly imbalances resolved. What once snapped back now drifted. The tension deepened when algorithms adapted. Automated strategies rely on predictable responses. When timing changed, those strategies recalibrated conservatively. They waited for confirmation. They reduced aggressiveness. The system became more reactive and less anticipatory, even though no one told it to be. Participants began sensing the difference without naming it. Small sell-offs took longer to stabilize. Bounces felt tentative. Confidence no longer arrived instantly. It required proof. And proof in markets cost time. The most telling shift appeared during routine stress. Events that once passed unnoticed now lingered. Prices didn't collapse, but they didn't recover cleanly either. Participants watched each other more closely, unsure who would act first. The market wasn't afraid. It was uncertain. That uncertainty fed on itself. When fewer participants act decisively, others hesitate. Liquidity becomes conditional. And when liquidity is conditional, psychology changes faster than fundamentals ever could. Risk managers notice the pattern next, not through losses, but through behavior metrics. Time to stability increased. Order cancellation rates rose. Execution became more fragmented. None of it violated limits, but together, it painted a clear picture. The market's reflexes had slowed. The routine decision hadn't removed safety. It had changed expectations. And expectations are the backbone of market psychology. They determine whether participants lean in or step back. whether they trust the system to respond or prepare to protect themselves. As weeks passed, the shift solidified. Traders spoke differently. Language changed from confidence to caution, not because conditions worsened, but because predictability had softened. And once predictability erodes, psychology follows. The decision that was meant to streamline behavior had done something else entirely. It had taught the market to wait. And a market that waits reacts very differently when pressure finally arrives. The difference became undeniable when pressure finally arrived. Not a crisis, not a shock, just a sequence of events that tested the market's new reflexes. A data surprise here, a policy comment there. Individually manageable, collectively revealing. Prices moved and paused. In the past, these pauses would have been brief. Buyers would step in. Sellers would retreat. Balance would return quickly. This time, the hesitation lingered. Participants waited for confirmation. That never came. Liquidity appeared in bursts, then vanished. The market felt hesitant in its own movements. The conflict intensified as feedback loops formed. Small declines encouraged more waiting. Waiting reduced depth. Reduced depth amplified movement. None of it was dramatic, but it was persistent. The market wasn't panicking. It was second-guessing itself. Algorithms struggled with the new rhythm. Systems designed for continuous response now faced discontinuity. They pulled back when signals conflicted. Aggression dropped. Reversion strategies lost effectiveness. What had once been smooth now felt uneven. The buildup accelerated when leverage strategies reacted, not out of fear, but out of caution. Risk controls tightened. Exposure reduced incrementally. Those reductions, in turn, reinforced hesitation. Each step was rational. Together, they created fragility. Observers began noticing the change in tone. Commentators spoke of choppiness, of lack of follow-through. But these were descriptions, not explanations. The real shift was psychological. Participants no longer trusted the market to behave the way it used to. The routine decision had altered the implicit contract between participants. The shared belief that responses would be swift and predictable was gone. In its place was a new norm: wait and see. That norm changed everything. When markets wait, momentum dies. When momentum dies, volatility becomes erratic. And when volatility becomes erratic, confidence erodes quietly, not through fear, but through fatigue. The tension peaked when a larger stress event loomed. Participants didn't know how the market would respond, and that uncertainty mattered more than the event itself. Positions were lighter, time horizons shortened. Liquidity was offered reluctantly. The market had learned a new behavior pattern, and behavior, once learned, doesn't disappear quickly. The final phase would reveal just how deeply that routine decision had rewired expectations. And what happens when a system built on anticipation is forced to operate on hesitation instead? When the larger stress finally arrived, the outcome felt strangely familiar. Not because the event was severe, but because the market's reaction followed the new psychology perfectly. Prices moved faster than expected, not because fear exploded, but because conviction was missing. The hesitation learned weeks earlier now shaped every decision. The climax wasn't a collapse. It was a realization. The market hadn't become weaker overnight. It had become cautious by design. The routine decision had rewired expectations, teaching participants that responses would be delayed, uncertain, and conditional. And once that belief took hold, behavior followed naturally. Liquidity appeared later than usual. Buyers waited for confirmation that never felt sufficient. Sellers acted defensively, not aggressively. The system didn't fail, it slowed. And in markets, slowing under pressure often produces the same outcome as panic. As volatility expanded, analysts searched for causes. Some blamed sentiment, others blamed positioning. A few blamed external shocks. But none of those explanations captured the deeper truth. The market was responding exactly as it had been trained to respond. The resolution unfolded quietly. Over time, participants adapted to the new rhythm. Strategies adjusted. Expectations recalibrated. The market found a different kind of balance, less fluid, more cautious, more reactive. Stability returned, but it looked different than before. The lesson lingered long after prices settled. Market psychology isn't shaped only by crises or headlines. It's shaped by structure, by timing, by small procedural choices that alter how participants anticipate each other's actions. The routine decision didn't change rules. It changed belief. And belief, once shifted, rewrites behavior faster than any regulation ever could. Understanding markets means understanding psychology. And understanding psychology means paying attention to the quiet decisions no one debates. Because those are the ones that reshape expectations without ever announcing themselves. So what do you think? What routine decisions are quietly rewriting market behavior right now? How